three key themes I just wanted to really touch on over reporting season. And the team, as they take time to dissect the results, will run through their thoughts post-reporting season as well once they dive into the detail a little bit more. So three key takeaways from myself and Tom. So despite all the usual noise around the reporting season, was fairly benign overall, which I must stress is actually a pretty good thing. Just given all the uncertainty leading into reporting season, a benign reporting season where price reactions were pretty muted is probably a good thing. So price reactions, in fact, were the most subdued that we've seen for some time, particularly around the reporting season. Bids for large caps were up just 2%, and misses for large caps were down 3%. This is compared to the usual 5 or 6% swings that we normally see for bids and misses around the large caps. Secondly, the market's concern around a collapse in FY23 expectations, as we highlighted in the reporting season preview, again proved to be premature. As we saw pretty resilient trading conditions continue to hold. We saw, in fact, 2/3 of the market saw a less than 5% change to FY23 EPS numbers. And with the average revision just down 1%, it goes to show generally consensus expectations for FY23 were pretty close to the mark there. As we heard from CDA last week, the bulk of the roll-off on fixed rate mortgages don't really hit until the second half of 2023. And with the RBA unlikely to hit their terminal cash rate until for Q1 2023 as well, and given the lag between sort of when the interest rate hike hits and when it actually gets felt by the consumer, we are looking to FY24 and really before we start to see a lot of that pain really be felt. So we don't see huge downgrades to 2023. So particularly when the market is so cautious around 23 earnings, we think they're going to hold up okay. But this also means that as we go into AGM season, as we go into that Christmas period, there's going to be heightened attention around trading updates there. So no doubt more volatility ahead as we go through those periods where we get another glimpse as to how corporates are trading around those type of periods. It's also encouraging that we've seen PE ratings rather than outright EPS downgrades. So that really drove the weaker prices through reporting season. So it looked like more a response to what's happening overseas and what's happening around the macro rather than a change in the domestic view. So we certainly think there's plenty of value on offer there for those prepared to look through the short-term noise around what can happen around 23 earnings. Hence, when we look at our best ideas, we have maintained conviction around many of our names with very few changes to the best ideas list this month. So just diving into some of the sector trends, the largest drags on aggregate were stocks that had forecast very strong EPS growth for FY23. So particularly for large caps, it was where some of these large caps have really strong EPS growth expectations, and they have now been pared back because I guess they are returning to a more normal trading environment. So if you think CSL, Ramsay, AGL, TPG, as well as Woolworths, many of these forecasted to see pretty strong growth. But EPS revisions, they're really bringing more in line with more normal trading conditions. So this probably likely explains why we didn't see those huge reactions to large cap misses. Also on my point earlier on the chart on your right, generally speaking, price reactions were a function of PE derating rather than a downgrade in expectation. So looking across the sectors there, you can see that the bulk of them really, EPS expectations actually held up quite well. It was more a case of, a downgrade to valuations rather than, or derating of valuations rather than anything more sinister happening in earnings. So it does support our view there. FY23 expectations had enough conservatism really baked into the numbers. And, and looking out to FY23, there's only about 16% of the companies that we looked at through the reporting season providing some form of quantitative guidance. This compares to a 23% number the same time last year. So we're seeing fewer companies, in fact, provide first-time guidance, quantitative guidance. So again, what we think that will lead to is, again, some pretty conservative estimates for FY23 and enough buffer there should economic conditions start to really deteriorate. So we do think earnings will actually hold up once again. So one of the segments that did really stand out in our view was quality. So we've done the Lexus trade. So why the Lexus trade? So no offense to any Lexus driver out there, but look, it doesn't have quite the prestige of a BMW or a Mercedes. But, one could argue that it's on par when it comes to quality. So when we're looking at the market, very similar sort of philosophy there. We're looking at companies there that are trading in that 50th to 70th percentile, that aren't trading on eye-watering multiples, that are your quality names, probably not your typical quality where you sort of think of, trading at 50, 60 times. These are typically trading around 20 times to about, 28 times. So if you think of names like ALQ, Breville, IPH, Jumbo, Lovisa, Pinnacle and Reece, Treasury, to name a few, a lot of those are in our best ideas. They did actually hold up quite well. So these are companies with pricing power, above average ROE, consistency of earnings, all those traits that we think, puts them in good stead to actually ride out the economic storm that can potentially hit as interest rates start to rise. So other themes that I just wanted to really quickly touch on was on M&A. So really strong balance sheets, cashed up creditors. So we've seen trade buyers, PE firms, super funds, very cashed up. So the team have put together 37 candidates, M&A candidates, and they have a good history of identifying companies that have performed quite well and been takeover targets. So I urge you to have a look at the report. There's 37 names there identified as targets. We also look at dividends and buybacks. So payout ratios we know are down. They're down from about 72% to 67%. But it's not all bad news. With the pullback in prices, many firms have opted to also deploy buybacks as well to return cash to essentially boost up, sagging share prices. So using buyback as a form of capital return there. So it's not all bad news for dividends, and then also commodities we also dive into. So the market was well prepared for the higher cost environment, and that's why many of the results came in as no real surprise. Dividend and cash flow continue to be quite healthy, particularly around the large cap miners. But as we look to the Congress meeting next month, as Ray Chan so comprehensively covered for us yesterday, we'll look for clarity as to what the Chinese government will do on policy, what it means to demand. We certainly think as we come closer to the end of the year, we'll get a lot more clarity there, and you may see a bit more buying returning to some of the commodity stocks. So in the interest of time, I won't go through all of this list, but it was generally the reporting season was far more to like than to dislike. Trading activity suggests that demand remained quite consistent, with very little evidence that things are starting to soften. So the few areas concerned were really some of the supermarket operators. They are cycling more difficult comms, elevated valuations, and higher investment spend. So that's an area to look out for. And building materials, it really has been hit on all fronts: labour shortages, cost inflation, unfavourable weather, and many lack pricing power, which really continues to hit margins for building materials companies.